deal has been mixed, as you'd expect on the sell side. UBS, as you mentioned, kind of positive on this, saying that A, it removes the question over the need to raise capital, and they now think that Rivian will not need to raise capital through at least 2025. Mixed because you think back to yesterday, Wedbush had a very different view, cutting its price target on Rivian and basically labeling the convertible as a misstep. Last Thursday, the session after they'd announced the convertible, the stock fell 23%, the biggest drop on record. And where Rivian stands now is they have $9 billion of cash on hand. UBS are going with the positive, saying that this shores up the balance sheet, but they also now can focus back on the fundamentals. A big underlying story is that Rivian has not really budged guidance from the 52,000 units that it plans to build this year, and there's like this growing frustration amongst investors about how Rivian's leadership communicate with investors on timing. When they announced the convert on October 4th, some on the sell side said, well, this happened a bit sooner than we thought. It will obviously have a dilutory effect on the interests of current shareholders going forward. All in all, it's a company that's building EVs, different from others.
Ed, thank you, mate. Stock's up by 2.5%. Looking forward to the program a little bit later with Ed Ludlow and Caroline Hyde, Bloomberg Technology at noon Eastern time. Do two things right now. Take a look at the bond market, big rally, yields lower. Take a look at the banks. That positive correlation between treasuries and banks continues. Treasuries rallying, banks rallying as well. Bank of America up by about 1.7%, going into earnings next week. JP Morgan kicking things off on Friday. Those results just around the corner. Let's turn to the financials. Truist reportedly in talks to sell the rest of its insurance brokerage to private equity firm Stone Point Capital for roughly $10 billion US. The CEO saying earlier this year the unit has continued to perform extraordinarily well, and we will continue exploring strategic options to maximize shareholder value. Katie Greifeld has this one. Hey, Katie.
Hey, John. Yeah, Truist up more than 5% on the heels of that Semaphore report that, like you said, the regional bank's in talk to sell the rest of its insurance unit over to Stone Point for about $10 billion. Now, remember, Stone Point led the investor group earlier this year that bought about 20% of the insurance business for about $1.95 billion. Now it appears that Stone Point is coming for the remainder. Though, according to Semaphore reporting, it's important to note that talks have yet to reach a conclusion and may depend in part on Stone Point's ability to obtain financing. Now, Truist might be motivated here to sell as part of its efforts to shore up its balance sheets. We all remember what happened with the banks in March, and Wall Street seems to be welcoming this move. Citi actually wrote that the remaining sale for the stake for $10 billion, that would imply a, quote, larger valuation of $12 billion, or about $2 billion greater than February's original common equity valuation. So the valuation going up here would definitely help explain the rally that we're seeing this morning. Truist currently up about 5.3%.
Katie, thank you. John Hancock's Emily Rowland with this to say, weighing in on the macro environment, saying the equity market is telling us that high yields are going to make things harder for more cyclical businesses as restrictive borrowing costs hurt the consumer. Against this backdrop, we would consider adding defensive stocks like healthcare and utilities, which are now on sale. Emily, I'm pleased to say, joins us right now. Emily, let's go there. Utilities are on sale because of high yields. Consumer discretionary is down because of high yields. Why do I want to avoid one and buy the other?
Yeah, John, we see a lot of challenges coming up for the U.S. consumer based on really the higher cost of capital. So what's happened is that you've seen better economic data in the U.S. So we look at things last week like the ISM manufacturing index coming in at 49.0 with new orders at 49.2, so picking up. You've got JOLTS coming in better at 9.6 million. That blowout jobs report last week, let's not forget it, 336,000 with significant upward revision. So what's happening right now is that stronger economic data really means that the U.S. Federal Reserve is probably going to be the last hawkish central bank standing. The downside to this is that there's even more tightening being put into the system. So we look at 30-year mortgage rates, hitting a 23-year high last week, mortgage applications hitting a 27-year low. So we think what happens here is that there are significant challenges here, not only to the housing market, but also to the broader economy. So if you lean into less cyclical areas of the market, parts that have not as much of a need to tap the capital markets, more durable profitability, less of an interest burden, that's where we think investors should go. So it's really about this combination of quality and defense that we think makes sense in portfolios.
Emily, when we get the bank earnings on Friday and through next week, are you expecting those results to speak to that slowdown you're anticipating?
Yeah, I mean, I think that's what everybody is looking for is, are we going to get a read on the U.S. consumer? And when we look at earnings growth more broadly for this quarter, this is the last quarter where negative earnings growth estimates are being penciled in for the market. So the bar is pretty low. When we look into the financial sector, about 9.3% earnings growth is expected for this quarter. There are some tailwinds there for the financials. We've seen a doubling of interest rates since Q3 of last year. Remember, the Fed's funds rate was only between about 1% and 3% this time last year. However, the yield curve was steeper last year, so that could play into things. And then, of course, we'll look to see how those loan loss provisions get factored in as these challenges to the consumer persist. I think the consumer is fine. Right now, certainly, we talked about the employment dynamics. The labor market's really healthy. Consumers are still okay, but I think there's a lot of mounting evidence that they may be starting to pull back here, again, as the cost of borrowing is so elevated.
Emily, we talk a lot about the relationship between the bond market and stocks, the broader equity market. Can we talk about the relationship between treasuries and banks? What do you make of that through this year so far? Is that going to change anytime soon?
Yeah, it's really odd. So normally financials trade on higher interest rates, and that relationship is really broken down, but we haven't seen a backup in rates to this extent really in modern history. We have to go back a really long way to see a Federal Reserve that's raising rates by over 5% in an 18-month time frame. That's just really extraordinary. So I think markets, investors are more focused on how that changes the narrative in terms of tipping the economy into recession. We all know that the Fed hikes until something breaks, and everybody's getting incredibly impatient to sort of wait and see how that plays out and how the economy ultimately tips into recession as this tide of liquidity is removed from the system. But that's really what we see, I think, Treasury markets reacting more to, or banks reacting more to now, is how is that challenge to the consumer? How is that challenge from tighter financial conditions going to impact banks? They're more cyclical. They're not our favorite thing for a late cycle environment.
Emily, what is your favorite thing for a late cycle environment?
Yeah, so again, it's this combination, I think, of quality and defense. So I think there's going to be a big change in consumer behavior. People might not buy that next consumer discretionary item, but they're still going to turn the lights on and take a shower and go to the doctor and, I guess, eat those Doritos. So I think that sounds terrible to me, but I'm sure my 13-year-old would love those. So I think you're going to see a bid for the things that people need to do. So areas like utilities, defense, think infrastructure, think toll roads, data centers. I think those are areas that we like. Healthcare has got a 20% return on equity. It's actually trading at a 10% discount to the S&P 500. So those are areas that have sort of been left in the dust until very recently. And we think that the baton can be handed over to them as we head into the back half of this year and into 2024.
Let's put a bow on it. You're looking for a slowdown. Morgan Stanley has said they're looking for a noticeable slowing in Q4. We had two guests to start this program today, Emily. Jim Bianco, one over at Bianco Research, Mike Contopoulos over at RB Advisors, who said they're not looking for a slowdown. Why do you think it's different this time after we've seen so many people get this call wrong time and time and again through 2023?
Well, it's a timing thing, and I listened to Jim, and I agree with him. I think things could be okay for a little while longer. You look at the yield curve inversion. We're at about 12 months right now. You look at, if you look at the Fed funds and 10-year rate, you look at the leading indicators, they've been negative for about 13 months. We have had periods where those dynamics have persisted for 16 to 18 months. It was back in 06, 07 is the latest example, but the economy is reaccelerating. 336,000 jobs. We don't have a problem right now. So I think in earnings season, the bar's low. You could get decent earnings in the fourth quarter. So I think it's a timing thing. We could see 3 to 6 months of pretty decent economic growth and pretty good signs from the corporate side. I think it's after that, especially as expectations are so elevated now and there's animal spirits in the market that are driving markets higher, that's the challenge into 2024.
Emily, thank you for the update. Emily Rowland, of JH Investments. We are about 14 minutes into the session. We're positive by 0.2% on the S&P. Coming up, House Republicans preparing to choose a new speaker.
This is about a moment in time. This is about what America's going to do. I'll allow the conference to make whatever decision. Whether I'm speaker or not, I'm a member of this body. I know what history has had, and I can lead in any position it is.
The latest from Capitol Hill, up next.
Unfortunately, the House can do nothing without a speaker. I could be upset with 8, but I could be upset with every single Democrat as well. They both made the same decision, a political decision, instead of putting America first. This is about a moment in time. This is about what America's going to do. I'll allow the conference to make whatever decision. Whether I'm speaker or not, I'm a member of this body. I know what history has had, and I can lead in any position it is.
Former Speaker Kevin McCarthy willing to make a comeback, jabbing Democrats and Republicans alike for playing politics in the wake of deadly attacks on Israel. Without someone at the top job, congressional business grinds to a halt, even with bipartisan support for Israel in the chamber. Henrietta Trays of Veda Partners weighing in.
My hope is that we see the invasion of Israel really shake some things loose here in D.C. One of the things I'd like to see happen here is really move the Speaker's election along.
Candidates Steve Scalise, Jim Jordan vying for their colleagues' approval in a forum this afternoon before a secret ballot election on Wednesday. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons in Washington, D.C. Katie, first to you. Just walk us through the timeline for this election.
5 p.m. tonight, John, is when the Republican conference will be meeting to hear from the two front-running candidates for the Speaker's gavel. That, of course, is Jim Jordan, the Republican from Ohio, chair of the Judiciary Committee, really a hardline conservative firebrand who appeals much more to that faction of the Republican Party and, of course, has gotten the endorsement of former President Donald Trump. Then there's Steve Scalise, a longtime member of House leadership. He has been the number 2 Republican, appeals more to some of the moderates within the party. But at this point, the math doesn't work for either of them. It just does not seem that either of them can garner enough votes to get the majority they need in order to actually get the gavel, which is why we're hearing increasing muttering here in Washington about a potential McCarthy speakership 2.0. We, of course, just heard here McCarthy didn't necessarily rule it out when speaking at the Capitol yesterday, said he will do what the conference wishes, and there actually have been a number of Republican members who already have voiced support for a return of Kevin McCarthy to the speakership. The issue is the math doesn't really work easily for him either, remembering that 8 Republicans joined with every single Democrat to oust him just last week, so he would have to figure out a way to win some of the votes back. At this point, it's a very fractious-looking caucus, but they are going to try to coalesce around one candidate behind closed doors to avoid the embarrassment of bringing this vote to the floor and having to go another, say, 15 rounds like it took to get McCarthy the Speaker's gavel back in January. So this could be a protracted process as they try to get one individual a majority that they need. And of course, that voting, John, will begin tomorrow.
Anne-Marie, one subject, aid for Israel. Does this complicate things at all?
Well, it absolutely does, Jonathan. House Representatives cannot move forward with any sort of bill or legislation regarding anything, including aid for Israel, until they have a Speaker of the House. So they're at an impasse right now. What we do know in terms of aid for Israel, though, Jonathan, is that a group of lawmakers over the weekend had discussions with the White House. The White House will say it's too premature right now, but a discussion about linking Ukrainian aid with Israel aid. They view this as a way to potentially get some of these Republicans that do not want to move forward with Ukrainian aid to capitalize on the fact that they do want to move forward with aid for Israel. But one representative, Tom Cole, said this isn't fair. Israel should be addressed separately when it comes to Ukraine. But Jonathan, these are the type of questions we will see only after there's a Speaker of the House.
Anne-Marie, there was a feeling after the weekend that maybe this would provide some urgency to Washington. Terry Haynes, earlier on this program, he said Speaker selection odds aren't higher. He said shutdown odds aren't lower. What's the consensus view in Washington at the moment, Anne-Marie?
I would agree with the probability of that and the math around it. As Kaylee pointed out, it's going to be very difficult for one individual to emerge with getting to that magic number of 217. But I would say there is a growing urgency that this Republican Party needs to get its act together because they have now a long list of issues to address. And most notably, on top of that, given all their comments over the weekend, that's going to be standing strong and supplying support to Israel.
MH, thank you. Alongside Katie Lyons, Balance of Power a little bit later on, together with Joe Matthew at 5 p.m. Eastern Time on Bloomberg Television. About 22 minutes into the session, equities advance 0.25% on the S&P, up 0.3 on the NASDAQ. Let's get you some sector price action. Here's Abby.
The sector action this morning, John, is a little peculiar in the fact that the sectors on bottom, those that are underperforming, those are the dividend-sensitive sectors, the rate-sensitive sectors. So with yields down so much, you would think that healthcare and real estate would be rallying in a big way, tech as well. That said, we're looking at pretty small declines, so I wouldn't be surprised if those sectors join the other sectors. Consumer discretionary, the best sector on the day, up 1%, having to do with PepsiCo in part. Consumer staples, also a great sector, up 0.9%, and there are strong dividends there, so there we are seeing some of the more normal action relative to dividends and rates being down so much. As for energy, well, it is higher by just a little bit. This as oil is essentially lower by just a little bit, consolidating the gains. But take a look at the move up out of the June and May lows, up about 16%. Lots of volatility, though, John. Last week, down about 10%, now up about 5%. And it almost looks like there could be a V bottom there, suggesting that maybe the gains for the energy sector, they are going to continue.
Abby, thank you. Really busy week ahead. Tons of data, lots of Fed speak. The headline data point comes on Thursday. CPI just around the corner. Up next on the program, I'll get you that trading diary. 25 minutes into the session, the rally goes into day 3 on the S&P, up 0.25%. That's the price action. Here's the trading diary. Coming up and what you need to be looking for. President Biden discussing Israel at 1 p.m. Eastern from the White House. Fed speak continues through the day. Waller, Kashkari and Daly all on deck. Wednesday, US PPI and Fed minutes, and House Republicans planning to hold elections for the next speaker. Thursday, US CPI and another round of jobless claims, and on Friday to round out the week, big bank earnings kicking off with JP Morgan, Wells Fargo and Citigroup. From New York City, that is it for me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, October 10th. Here are the top market stories that we're following for you at this hour. The yield tumble. Treasuries rally. Yields fall the most since May as the Treasury sells over $100 billion in notes this week. And the peak rate debate. Investors see recent Fed speak as pointing to the end of the hiking cycle. We're going to see if it's right and if you should buy bonds. And small businesses still feel the pain. You got the latest NFIB data showing optimism hitting a 4-month low with worries rising over credit availability. We're going to get the analysis with Holly Wade, Executive Director of NFIB's Research Center. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And speaking of the Fed, Bostic just speaking moments ago saying that we're in a good place.
Yep.
for policy to get inflation to 2%. He doesn't seem to think that we need any more rate increases as of now.
They're all singing from the same hymn sheet. Wow, that was hard. Words are hard this morning. Peak rate debate. There we go. I've done that as well. Let's talk about this because I think this is fascinating. The market is looking at this and saying this is a reason to buy treasuries. Yet I thought over the last few weeks the reason why yields have been going higher is because we weren't necessarily pricing in higher yields, we were pricing in longer yields. And that now seems to be conveniently ignored. This feels more like a risk-off kind of move today, doesn't it? Is it really to do with the Fed? Because that's where people are pointing us.
Well, it does. And also it has the weird perverse effects that then if you actually go buy bonds based on the Fed being done, that it actually lowers yields, which may then loosen financial conditions, which may then reverse some of the job that the market's doing for the Fed anyway. So it does leave me scratching my head a bit.
I think there's many reasons to scratch one's head around all of this. Plus, as you pointed out at the top, we've got a lot more supply coming through. That's been a factor that I think everybody's been waiting for to see what impact that has. So I think there's a kind of a number of things that don't quite add up. But clearly, all of these Fed speakers, Alex, are now on message. And they are singing from the same hymn sheets, and they are saying the same thing. I could go on and on and on. This is what we've been hearing. Take a listen.
We've been making quite substantial progress on getting the inflation rate back down to where we want it.
I think current policy is restrictive and putting downward pressure on the inflation rate, and that's really what my concern is.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
Higher term premiums result in higher term interest rates for the same setting of the Fed funds rate, all else equal. Thus, if term premiums rise, they could do some of the work of cooling the economy for us.
I'm going to give it one more go. Singing from the same hymn sheet. There we go. Finally nailed that one. Our question of the day, a fairly straightforward one, therefore. If the Fed is done, do you buy bonds? In some ways that's intuitive, but if you take a look at the evidence, there's volume after volume that speaks against that idea. Let's bring in Bloomberg's Mike McKee and Ira Jersey of Bloomberg Intelligence. Ira, if the Fed's done, do bonds catch a bid? Should they?
So, yeah, historically, Guy, they definitely have in the past. I think one of the big worries now is what you talked about before is, look, if we price out any chance of a cut in 2024, then you're going to wind up having, the whole term structure is going to have to be somewhat flatter. So we wrote just today that we do think that the term structure will remain a little bit inverted to very flat for the next 3 to 6 months, and in large part because we think that the Fed is going to be on hold. Now, does that mean that duration does badly? Not necessarily. But keep in mind, you guys were talking about today's rally. The bond market's not rallying today. The bond market's actually selling off because you had the futures market open yesterday, and bond futures and 10-year note futures were suggesting we should have rallied about 18 basis points yesterday. So bond futures are actually off today by about 10 basis points. So really this was a flight to quality bid. It started yesterday, and now because the cash market's open, the cash market's really just catching up from the flight to quality bid we had yesterday.
It is such a good point. When you take a look at the future, I wish we had like an S&P futures, but for treasuries to that point. So, Mike, I guess then the question becomes, why are Fed officials coming out and saying that they're done?
Well, they're coming out and saying that, well, they're not exactly saying that they're done. They're hinting that they're done.
Kind of saying it. They're like, we're
They can't quite say it because then the market will react significantly. But they're hinting that they're done for the reason that they're saying that real rates have gone up a lot, and that's adding to this to the pressure on the U.S. credit markets. And so they may not have to do more. Now, part of this is based on the fact that we got this good jobs report without wage pressures rising, and the anticipation is that the inflation numbers are going to come in reasonably well this month. But I was going to add to your question of the day, should you buy bonds now? I'd say it's a little too early because there's enough data that could whipsaw this market around before we get to the Fed meeting. It's kind of hard to know whether there's a lot of conviction behind this or whether, as Ira says, it's just really kind of reflecting a flight to safety. And of course, that flight could go either direction from here, depending on what happens in the Middle East.
Mike, normally Treasuries get to at or around Fed funds rates at the end of the cycle. We're not there yet. The Fed's talking about this idea, we just heard all of them there talking about this, that the market is doing the heavy lifting now. But are they comfortable really that the market has gone far enough? Wouldn't they expect the market, at least on a historical basis, to get to where they are? Do you think they want the market to get to where they are?
I think they want the market to get close to where they are. It's kind of hard to say that you can push them exactly to where you are because you've got inflation premiums and term premiums and a lot of other things that are going to affect what investors are looking at in terms of where they're going. But it's the real rate that matters, and the real rate has been going up, and it is now at a point where Fed officials think that it is restrictive. I don't know if it's doing all the heavy lifting, but it is doing some now. And as long as that's the case, then Fed officials think that there's a reason to be cautious and they can hang on the sidelines. Mm-hmm. But again, I would urge caution because so much has been changing so fast this year that the only thing you could probably predict is volatility ahead.
Okay, fair enough. Hey, Ira, you've been talking about the pancake and that we're going to go from flattening to steepening, but it's really going to wind up being a pancake. Does that view still hold in light of what we've learned geopolitically over the last few days?
Well, there's a lot to unpack there, but I would say something, I just want to comment a little bit on what Mike just said. I think that volatility is really interesting. So our derivative strategist out in London had put out a piece this morning noting that implied volatility has been much higher than realized volatility in rates markets, suggesting that there is a lot of uncertainty going on. And because you have that amount of uncertainty, you can keep on seeing these whipsaws as you get various pieces of news and data, Fed speak and the like, that is going to push the market, 10, 15 basis points in a single day. So that wouldn't be a big surprise to see a lot more volatility. The supply story, I think, is a little bit overblown, primarily because we've known that the supply has been coming since August. So we would have presumably priced for that over the last couple of months. It's not just going to, happen all at once. Now, that being said, yep. When we get tomorrow's auction and then the 30-year auction, that is a lot of duration, a lot of market risk that people have to take on, and how good or not will that demand be at those supply.
Ira, how long would you expect the yield move that has been generated by the horrific scenes we've seen in Israel to last? This, as you say, is a slightly delayed knee-jerk reaction to the events over the weekend and ongoing into the beginning of this week. We've seen wars recently. What do we learn from those recent geopolitical events and their impact and how lasting that impact is?
So typically when you get the piece of news is when you get the major part of these knee-jerk moves and flight to quality moves. And as Alex said a few minutes ago, if the tensions wind up ebbing somewhat in the next week or two, you can see a complete unwind of those moves. But if they continue, then certainly they'll probably keep a little bit of the flight to quality bid into the Treasury market and away from some other potential asset classes that you might see. Now, one of the caveats to that is things like, will people buy tips if this stuff happens to affect oil prices, right? With some of the headlines out of Japan, what's going on in Iran right now, and things like that. It feels like a lot of people who are watching this probably weren't alive back then, but I remember 1979 and what happened in that period of time when you had Middle East tensions just shoot up very dramatically, and that affects oil, it affects confidence, it affects sentiment, and it affects the potential political and military responses to some of these things. So you can wind up seeing a bigger flight to quality bid if things escalate and get much worse, for sure.
And Mike, that's something that I feel like we learned from COVID and also from the Ukraine war, is that some of these shocks can be more permanently inflationary. Like, they might not be natural gas is up 300%, but it's still maybe going to be permanently higher. How does the Fed look at that?
The Fed thinks that at this point, the what they like to call R-star, the neutral rate, is going to be higher because we're growing faster. We seem to have had some productivity increases. Now, that's not around the world. That's for the United States. But if we see warm winter, which we just got a forecast from the European Meteorological Group for Europe and parts of the United States, then that helps hold down costs as well. On the other hand, you've got a gas leak in the Baltics that the Finnish say was some sort of sabotage. So you've got a lot of cross currents going at this point, and I don't know how you can really take a position. I wouldn't, but that's not my investment.
And that's why we don't trade.
Yeah, exactly.
Yep, Guy was talking about the weather. He said it was warm. He never talks about the weather in the UK in a positive way. Guy, thanks a lot. Appreciate it. Michael McKee and Ira Jersey of Bloomberg Intelligence. Thank you. So coming up, it is more insight into the question of the day. If the Fed is done, do you buy bonds? We're going to ask Stephanie Guild, head of investment strategy for Robinhood Financial. This is Bloomberg.
In terms of the bond market,
the bond market's around.
There's been such an incredible move in yields, particularly over the last month.
The upward trend in yields.
It's not surprising to see a little bit of a move back.
It is a risk-off sentiment.
Risk aversion that you've seen over the last few days also.
I mean, clearly there's an element of safe haven status going on here.
Treasuries to behave as that safe haven status like they have in the past.
Given the Fed speech lately,
it's the reaction from financial markets that has finally caused the Fed to maybe take a pause.
The market is doing a little bit of the work for them.
A lot of the work for the Fed.
The market is doing the Fed's job for them, and maybe they won't have to go quite as far.
The Fed is likely done with hikes.
We do think that bond yields will trend lower from here.
You can't believe that there's been a pivot in the space of 2 or 3 days.
It's really hard to know where we go from here.
Those were some Bloomberg TV guests talking about the moves that we've seen in the Treasury market, and that helps us to the question of the day, which is if the Fed is done, do you buy bonds? Joining us to discuss, Stephanie Guild, Robinhood Financial Head of Investment Strategy. All right, it's again a two-part question on that, I guess. Stephanie, what do you think? If the Fed's done, do you buy bonds?
No, I don't think you do. I think if you're going to buy bonds, you maybe do it in the short end of the curve. Long end of the curve, I just don't think it makes sense. I think 10-year yields are going to stay supported for a while. We've got a decent-sized deficit. The Treasury is expected to issue $850 billion of Treasuries in the third quarter. They're just finishing up $1 trillion of issuance. The Fed is reducing their balance sheet by $95 billion a month now. I think there's not really many reasons for the 10-year to start coming down or the long end of the curve, so I'd stay in Treasuries depending on your risk level.
Stephanie, I've just listened to all of that, and if I segmented it all and put it back together again, it does sound awfully like what you're telling me is you still think actually Treasuries yields could go higher from here. Is that what you're saying?
Yeah, I do. I think they could. I'm sort of calling for maybe like 5.5% range, 4.5 to 5.5% range next year, which is definitely a step up from what we've seen this year.
What would that do to financial markets? Like, let's say we get there, then what happens?
I do think we're going into a mild recession next year. I think this quarter will be fine, and I think earnings will kind of bring us, bounce the markets up. I don't think we're going to get above this year's highs, which is around 4,600 on the S&P. But I do think that next year we'll see a mild recession because all of the debt that's been taken on around the world in different formats will actually start to slow down economies. But it's going to take that, I think, 10-year Treasury and the higher end of the curve kind of rising before you start to see that happening.
Okay, let's recap again. So you don't like duration, you do like the front end, you're not convinced about equities at this point. So do I just sit in cash, Stephanie?
Actually, I like equities for this quarter, but I'm sort of getting more cautious for next year on the equity market. And for equity market next year, what I like is GARP, growth at the right price. So what that means is companies that I like to call this generation's utility companies, like tech companies, software services companies that focus on things that do things for other businesses and for consumers, have cash, have growth, but are undervalued at this point. And I think that's a good place.
Does that exist? Do those kind of companies exist? I see a lot of technology companies with quite high valuations.
They do. I'm not necessarily talking about the biggest tech companies, but I am talking about some of the unique ones that are sort of top players in their niche market, and that that might be like the exchanges, for example, or might be like the companies that provide financial service software software services. So those are, I think, just areas that are undervalued but still have good cash flow. Like that's what I'm looking for, good cash flow that don't need a lot of debt, because the ones that do need a lot of debt, it's going to be tough as the next couple of years go on.
So speaking of tough, small caps are tough. They got beat up a lot. They sort of rebounded from their lows a little bit. And that begs the question, like, as yields grind higher, is some of the bad news already in so much in certain areas?
Maybe in the small cap space, but small cap companies...
You don't sound convinced, but okay.
Small cap companies on average, if you kind of look at balance sheets on average, they take on more debt on average. They tend to be more in the industrial space and financial space, and they, as a result, are more cyclical. So if I expect a mild recession next year, I'm not sure if it's fully priced in yet.
One of the things we've certainly seen over the last few days is energy stocks catching a bid once again. Looks like oil prices have gone up very sharply. They've come down a little bit. And now, as a result of what we're seeing in Israel, they've gone back up again. Stephanie, what do you think of energy?
I've liked it for at least the last 6 months, and I do think the stuff that's politically happening in the Middle East is providing a floor to the oil prices. I think energy companies are still a good investment, and there's obviously a lot of M&A activity going on, but they've been through quite a rough patch over the last several years. If you go back to when oil fell by a lot in 2014, I just think they have figured out how to manage their capital and their balance sheets probably better because of the torture they went through several years ago.
Fair enough, and that was a rough time for sure. What do you hate right now? Like, what would you definitely not invest in aside from bonds?
I would not buy bond proxy stocks. So that's utility companies, maybe some consumer staples. There's sort of two reasons. One is that if you look at a utility company, I don't think you see a lot of growth. Like you buy it generally for income. And I think the average dividend yield is 3.8% in the sector. why do that when you can get 5.5%, 5.3% in the short-term Treasury market? I think in consumer staple world, one thing I'm also worried about is that you have falling goods inflation because supply chains have healed, and I don't see that coming back. Then you have these companies who've benefited. Most of them have FIFO, use FIFO, right, as their accounting format. I think you have an environment where wage growth kind of stays where it is, but their benefit that they got from goods inflation is going away, and so I think there's going to be some profit margin pressure there.
A lot of margin with that. All right, Stephanie, great stuff. Please come back. Stephanie Guild, Robinhood Financial Head of Investment Strategy. Thank you so much. All right, still ahead, the Israel-Hamas war is putting social media under the microscope as researchers say X, formerly known as Twitter, has proven an unreliable source for news. Details next. This is Bloomberg.
Authority.
It is 22 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. And Ed, today is a perfect day to look at X, formerly known as Twitter, and sort of what has happened to X in the last 24 hours as the media world and the regular world digests what's going on in Israel.
Yeah, so the Bloomberg Technology and San Francisco newsroom have a story out that cites a number of researchers that have basically looked at the content on the platform over the last 48 hours or so. And the main problem is the sharing of video content that purports to be one thing, but is in fact completely another. So as an example, there are lots of videos that are circulating on X which claim to be depicting events tied to the Israel-Hamas war that come from video games. They're not real, they're video game generated content. Or as an example that we cite in the story, there's video on X doing the rounds that claims to be Hamas going door to door in an unspecified location, and when you look into the origins of the video, it turns out that what is shown in that video on X is not Hamas. It is Israeli police and military forces. And so, this is a concern because Elon Musk and X have positioned themselves as the place for the most reliable news.
Twitter used to be the go-to for that reliable news.
Yeah.
A lot of people don't use it or haven't been using it during this crisis as a result of some of the things that you've been laying out. When there has been pushback to X's management, what kind of a response have we got to what we're seeing?
Well, Twitter used to, and I think the main point that X is making, and we have a statement from them that we can show you on the screen, is that this is the first sort of crisis situation that X, the reformed, renamed company, has to deal with. This is no longer Twitter. There's a new management team, and what I'm told is that that management team, Linda Yaccarino, the CEO, are fully focused on this. You guys will have seen she was due to speak at a Wall Street Journal event here in California. She has pulled out, and what the company told me is she's pulled out to deal with X's handling of this situation. The problem is that Elon Musk and the X platform still continue to engage themselves and share content, some of which has kind of shown to be inaccurate or false.
So, Ed, before the show, Mike said that he now follows Guy on Threads, and there's so many things that are wrong with that sentence, but is this like the win for Threads in reality?
Wouldn't go as far as to say a win for Threads, because, as we point out in the Bloomberg story, this issue of video and other media on X is also happening on TikTok and on Instagram's Reels and assuredly on Threads as well. There is some evidence that the video in question has originated from X and then been shared over to other profiles, and what you have is kind of these super users with big followings being a part of the problem, amplifying the fake content and then taking them to other platforms. But it's not unique to X. It wouldn't be fair to say that, and it is happening on other platforms as well. It's just that on those other platforms we have a better sense of their safety protocols, something that X is trying to build out for itself.
Ed, great stuff. Thank you very much indeed for the useful updates. Ed and Caroline on Bloomberg Technology coming up in around 90 minutes' time. This is Bloomberg.
about an hour into U.S. trading session on this Tuesday. You're seeing upside for stocks. That tech outperforming, NASDAQ 100 up by about 0.7%, and volume's not so terrible. Abigail Doolittle tracking the moves. Abby?
And speaking of the NASDAQ 100, Alex, this is surprising to me, a bit of a stealth rally here. Over the last 9 days, we have the NASDAQ 100 climbing each of those days. I'm going to check on that because one of these days looks like that may not be true. But over that time period, not a huge gain, up 3.9%, but it could signal a near-term trend shift here, especially for big tech. So let's take a look at what's happening on the day. So the NASDAQ 100, as Alex was just mentioning, up about 0.7%. The S&P 500 up for a third day in a row. That's the longest winning streak going back to the end of August. For the NASDAQ 100, that 9-day winning streak, if it is in fact the case, that is just since September, since there's been strings of long winning streaks for the NASDAQ 100. Again, it's been a strong year for the NASDAQ 100. The Goldman Sachs non-profitable tech, take a look at this, up 4.7%. That's a little bit of maybe a race for a dash for trash, as some folks say. So there's a sense that maybe there's this FOMO right now. Investors want in on the possibility that a rally is starting, a near-term rally. The Russell 2000 up for a fifth day, up 1.4%, and the KBW Bank Index up 2.1%. Now, what is the impetus for all of this? I would have to argue it's yields. If we take a look at the 10-year yield here, we are going to see a bit of a round trip. So last week, at one point, we were up, we had been up about to 488 here, and here it is, a very high level, the highest since 2008, and then some volatility, and then, of course, the haven bid right now on the Israel-Hamas conflict. Right now, again, back to levels that have been. I can easily technically make the case it's going to go back down toward 430 to 440, somewhere in there. What does that mean for the S&P 500? Well, this is a new chart we haven't taken a look at before, but here is an uptrend. Take a look at this. The S&P 500 hitting the one-year uptrend perfectly above the 200-day moving average, going for that 50-day moving average. Alex, I suspect that this is going to be a near-term rally. There's not quite of a V bottom there, but I do think that we'll probably see stocks continue to go higher, and again, rates appear to be the impetus. And of course, we have earnings season starting.
Yeah, I mean, it's CPI tomorrow, so that's a big wild card too. All right, Abigail, thank you very much. Really appreciate it. So the U.S. Small Business Optimism Index dropped to a 4-month low in September, with more owners now expecting business conditions to get worse. Natalia Knežević is here to break it down for us. Natalia?
So, Alex, this index is still way below the 40-year average, and last time it was at or above this level in December 2021. So small business owners are saying that it's getting much more complicated to get credit, but overall, the top two big problems for them are inflation and the labor market. So when it comes to inflation, about 30% of small business owners, that's going to be the next chart, expect or plan to increase prices, and they say that demand is still too strong to trigger any price reductions. And of course, labor market and those increases in wages are one of the biggest components when it comes to price decisions. Let's flip off the board and look at top sectors where small business owners are having difficulties when it comes to finding the right people. So the top sectors are construction, retail, manufacturing, and services. And overall, about a half of small business owners have problems when it comes to filling the job slots, and of course, it means that they have to increase prices. And people are still quitting their jobs. They are looking for other opportunities when they can get higher salaries.
So this is a fairly gloomy report, certainly reads like that. Natalia, thank you very much indeed. Let's get some more instant analysis on how we should be reading the NFIB data. We're joined now by Holly Wade, the Executive Director of the NFIB's Research Center. Holly, great to see you. Thank you for joining us to work our way through these data. How should I be reading it? It feels gloomy. It feels really gloomy. It feels like things are getting tougher. Is that the correct interpretation?
Yes, small businesses are not optimistic. More are thinking that business conditions will worsen in the next 6 months, and that is not a good position for small business owners to operate. And the environment is looking challenging, to say the least. Whether it's a few more saying credit conditions are worsening, or they expect credit conditions are worsening, but still inflation and the tight labor market are the two biggest challenges that are facing them right now.
So obviously, Holly, what really helped was being able to pass on price increases. Do small businesses feel confident they can still do that?
Well, it's moderated quite a bit, even though 23% are saying that inflation is their single biggest problem in operating their business. But it is a different picture from what we saw last year, when far more were saying that they were planning, or that they did, increase prices. So with that moderation, we've seen a slowing in their either ability to increase prices, or whether the pressure is not quite as extreme as it once was. But it's still a problem for them to navigate these headwinds that they're facing on that front.
To what extent is this about the cost of capital as well? Is it about the cost of capital, or is it about the availability of capital? What's happening on the credit front and the ability of these